Happy election day and happy Federal Reserve Bank meeting week. This is going to be an interesting week for the economy and markets because number one, we're going to get a new president elected. And number two, the Federal Reserve Bank is going to announce on November 7th what they want to do with interest rates. Now, the markets have already priced in a 99% chance that the Federal Reserve Bank is going to cut interest rates by 25 basis points, meaning 0.25%. What does that mean? That means if you're hoping that the Fed is going to cut interest rates and you're going to see a lower mortgage rate, lower refinance rate, lower car loan rate, you might be disappointed because markets are already pricing in pretty much a guaranteed 99% chance that the Fed is going to cut interest rates by 0.25%. Which means if the Fed does what the markets expect, you might not see any shakeup with bonds, mortgage rates, refinance rates, or car loan rates because lenders have already priced in the fact that the Fed will probably cut interest rates by 0.25%. So unless the Fed does something different, you might not see a big drop in mortgage rates or car loan rates. And this is where the bigger thing that you want to pay attention to isn't just what the Fed does, unless the Fed does something different than what everybody expects. But what you want to pay attention to this week is going to be what the Federal Reserve Bank says about what's coming. Now, the Federal Reserve Bank, although they're called the Federal Reserve Bank, they're not supposed to be federal. They're not supposed to be influenced by who is in power in the White House. So you probably won't hear much about how they're going to change policy because of who is in the White House. They're not supposed to say that. But what they might say is based off of where inflation is heading, based off of where the job market is heading, this is what the Federal Reserve Bank now predicts is going to happen with interest rates in 2025. That's the piece of data that Wall Street, every corporation, every institution is going to be keeping their eye on because the Federal Reserve Bank may say that they want to be more aggressive with interest rate cuts to stimulate the economy, even though we keep getting very strong economic numbers. Or the Federal Reserve Bank might say the economy is stronger than we thought. The job market is stronger than we thought. And we may not need to be as aggressive with our interest rate cuts, which would definitely shake up markets and shake up the economy because you have a lot of institutions, you have a lot of bankers, you have a lot of companies that are still hoping and praying that the Fed is going to be very aggressive with interest rate cuts, despite the fact that we've gotten generally strong economic data. Now, of course, the last job market report that we got last week came in very bad. I mean, we added a fraction of how many jobs that we were expecting, but many people were attributing the bad job market report to the fact that we had a hurricane and strikes at Boeing and other companies. So we'll see what happens with that. But that's what you want to pay attention to with the Federal Reserve Bank, because unless they say something shocking, we might not see a big shakeup over there. And the second piece of news that we got just yesterday is that we got new limits for 401k investments and IRA investments. But before I talk about that, I want to remind you one more time that if you are an investor, you're a stock market investor, and you're looking for help on how do you find unique investment ideas in the stock market, we publish a newsletter at Briefs Media called Market Briefs Pro, where my team every week is looking to identify a market shift in how spending is changing in the economy and how this can create a unique investment opportunity. If that's something that you're interested in learning more about, then I have a video on how you can learn more about Market Briefs Pro and potentially apply for a content demo to see if we can help you with the research and the data side of things. So if that's something that you're interested in, I got that link for you down in the description below. Now I want to talk about the new 401k limits. This applies to 401ks, 403bs, most 457 plans, and the federal government's thrift spending plan. And what they said is that because we saw the inflation in 2024 and previous years, they're going to increase your contribution limits for your 401k. In fact, they're going to increase the cap of how much you can invest in your 401k from $23,000 a year in 2024 to $23,500 in 2025. So you can invest an additional $500 next year because of inflation. For your IRA though, not so much good news. The annual contribution limit on your IRA next year is going to be $7,000, which is the same as what it is in 2024. Now, tomorrow I have a video going live on the new tax brackets for 2025 because we have new tax brackets coming. So if you want to learn more about what's happening with taxes, definitely check out my video tomorrow. But what this means is you have a lot of people in the government that are now essentially saying that inflation is no longer a concern. How do we know that? Because, well, number one, we can take a look at the limit increases here with your 401ks, but also because the Social Security increases have also dropped significantly. Now, yes, we have seen the rate of inflation fall from 2021 to where we are today. However, the impacts of inflation have not fallen. What do I mean by that? The Federal Reserve Bank is looking for disinflation. Disinflation is when the rate of inflation falls, but inflation compounds. So if something cost $100 5 years ago, and then you see 2% inflation, 2% inflation, 2% inflation, 2% inflation, and then this year you see 1% inflation, that doesn't mean that the thing is going to fall in price. It means that the thing has already risen in price, and now it's only rising by a slower amount. That's what disinflation is. And what we have seen is that between 2021 and for the first part of 2024, the rate of inflation, the reported rate of inflation, has grown faster than incomes. The reason why that's a problem is because today the talk is reported incomes are rising faster than reported inflation. And this is why you have a lot of people in the government and the Federal Reserve Bank saying that the war on inflation, the fight on inflation is over because incomes are finally rising faster than inflation. Which if we stick with that assumption, if we stick with the numbers and just stick with that assumption, that might sound good. But the problem is it doesn't make up for the big rise in inflation over wages between 2021 and 2024, the beginning part of 2024. Not to mention the fact that reported inflation doesn't actually give many people the full picture because the reported inflation between 2019 to today is about 23%, which means if you could buy a grocery list for $100, you buy your groceries for $100 in 2019, today it should cost you less than $124. That's what it's saying on average. But what we know is that the prices of many things have grown significantly faster than that, especially the prices of things that many people need. For example, many people have seen their grocery costs rise more than 23% over the last 5 years. For example, the cost of housing has grown by 50 to 65% over the last 5 years. Not to mention rent costs have also increased. Not to mention that car insurance prices have increased by around 50% over the last 5 years. So this is the dilemma and concern that many people have been talking about. And this is why many people have been upset. I've been talking about this a lot recently as well. But many people have been upset because they feel like we're getting all this good economic news. We keep hearing that incomes are growing faster than inflation, but many people are still struggling to be able to buy things. And that's the dilemma that's going on right now, where the government and the Fed are saying that the inflation problem is no longer a concern because wages are rising faster than inflation, which even if we stick with that assumption, that's fine, but it doesn't make up for everything that we have seen happen over the last 3 years because it's going to take a very long time at this rate to see wages outpace reported inflation to see any significant difference in what's happening. Now, we obviously have an election happening right now, and that can play some impacts. Now, I don't want to get into the political side of things because if Trump wins, I'm going to be back here working in the office tomorrow. If Harris wins, I'm going to be back here working in the office tomorrow. And I really like what Dave Ramsey says about this, which is you got to care more about your house than what's happening in the White House. I'm 100% in agreement of that. But the thing that I do want to say is that as an investor, there are unique opportunities depending on who wins the White House. Because what we do know is that generally when a Republican wins, we will see more investment in certain industries. For example, defense companies. For example, oil and gas companies. For example, deregulation in financial industries. We also know that generally when a Democrat wins, we see investment into other industries. For example, we generally see an expansion of things like Medicare and Medicaid, which would mean more spending into those healthcare companies that benefit from that. We also generally see more investment into alternative energies, green energies, non-oil and gas energies. Although Harris has talked about recently that she has been more open to the idea of oil and gas companies. And so this is where there's going to be a lot of emotions. There's going to be a lot of political tensions. But at the end of the day, it is up to you to take care of what's happening in your house, regardless of what's happening in the White House. So make your vote. But then, whatever happens, now continue living your life, continue doing what you got to do to take care of your family and your community, no matter what happens. And as a financially savvy investor, it's up to you to figure out, no matter what happens, how do you win? Because regardless, let me tell you something that you may not like to hear. Regardless of what happens, here's the truth. We have seen markets rise under Democratic presidents. We have seen markets rise under Republican presidents. We have seen markets fall under Democratic presidents. We have seen markets fall under Republican presidents. So as much as you want to believe or want to wish that one president is going to make you rich, at the end of the day, it's what you do. It's what you do with your savings, it's what you do with your investments, and it's what you do to actually earn some money. So now, here we have the election. Go out and vote, and then be smart. Understand the opportunities, understand how there's going to be shifts in the economy, understand how there's going to be shifts in spending, and then learn to create wealth for yourself regardless of what's happening. That's where wealth is built. Now, of course, we work to keep you posted with that with Market Briefs Pro. We also have a free newsletter called Market Briefs where we keep you updated on what's happening in the markets. If you haven't checked that out, I have the link for you down in the description. But my goal for you is to be a financially savvy investor. I understand I probably upset a lot of people with this video, but hey, I don't make these videos to make friends. I make these videos to help you be better with money. And with that, I'll see you on YouTube tomorrow.